Hello, good evening. How are you? Yes, the class is not started. I'm just starting it right now. Yeah, Yusuf, I was over here. I just got back like around what, 15 minutes ago or something. So I was just changing and getting up myself and getting ready. So that is why, I had to take a bit of a time. Okay, so last time we started off with the basics. I discussed and started off with the IAS 16, and we did happen to talk about as far as the basics were concerned. We talked about the initial measurement, then we talked about the cost itself, the components of the cost that can be there, then the subsequent measurement and all. And the subsequent measurement, before the subsequent measurement, we did happen to talk about the subsequent expenditure as well. I mean, say in case if you expense or you incur in cost onto the non-current asset in such a way that it's the performance is enhanced or its useful life is increased or something, right? In that case, we capitalize that cost, right? And if there is repair or maintenance or something, then we expense it out into the income statement, right? So I have to continue from the same very point, and let me just share my share. Okay, and let me just set up the screen. Okay, so over here today, basically we'll start off with the slides basically because I have to touch the other standards over here as well, along with the practice as well, right? So basically we start off with the basic definition. We have done all of this work onto the Word file last time, yes. And most probably what I remember, I have uploaded the file onto the Academy's portal as well. I mean, if you try to access the video lecture from the Academy, right, Academy's portal, you must have seen the Word file over there. I don't know if you guys have tried or not, but I have already uploaded the Word file over there. And this PowerPoint slide, I was just going through some changes in this, so this will be uploaded after today's class as well. So we talked about the initial valuation, that is on the purchase cost plus the subsequent expenditure that adds on to the asset plus the cost of the replacement if all parts are accounted for as a disposal. We are going to talk about this one. Then the repair and maintenance costs are the revenue expenses. They must not be included in the cost. So we have already discussed this point. And the directly attributable cost, the professional fee, delivery charges, site preparation, all done. Therefore, price discount excluding the sales tax is 80,000. Price discount is 2,000. Sales tax recoverable is 15,000. Delivery cost 500. Site preparation 1,200. Assembly and testing is 1,700. Right. So if we calculate the cost over here, that is going to be the purchase cost minus the price discount 2,000. Sales tax is recoverable, so we are going to ignore. We are not going to take this into account. Similarly, if we see the delivery cost, it's added over here. Similarly, the site preparation and assembly, they are added over here as well. And then we get the cost of the asset. Now, this example is something, or related to this example, we have already covered over here as well, right? I mean, the long story cut short over here, I mean, if we look at this example, the rule is simple that the recoverable tax is the tax paid on the purchase of the cost that the entity is able to reclaim from the tax authorities, right? So the sales tax on the purchase or on the purchase by the business entity is usually recoverable. Huh? So that is why we have excluded it from here. And if it's not recoverable, or the the tax which has been paid is not recoverable, then obviously it's going to be included in the purchase cost over here. Then we talked about the site restoration cost. Site restoration cost we have already talked about as well, that the initial cost of the non-current asset should include the present value of the expected future site restoration cost. So this is something which we have discussed in detail as well. right? Now, the point from where we have to start today is this one, the complex assets. We have to explicitly talk about this standalone concept over there in the tangible non-current assets, because some tangible non-current assets are accounted for as complex assets, right? Now, a complex asset is an asset that consists of several different parts, each of substantial value and each with a different expected useful life, right? Now, one example is an office building in which you have the elevator system, you have the air conditioning system, you have the heating system, you have the main structure of the building as well, right? Another example, you have the aircraft which has its body, the engines, the exterior, and the interior as well. Similarly, you have a complex asset as a train itself, train's engine, its bogies, the clippers which connect the two bogies together, and then again the interior as well. Similarly, you have a cruise ship as well, like the cruise ship's engine, its body, and then its entertainment and area fitting, etc. as well, right? So we have number of complex assets with us where each component has a significant value and they have a different useful life. So the rule is simple, that when we are going to have some sort of a component, when we are going to have some complex asset or something, and then in that complex asset, when the component parts of that asset have different useful life, this means that the part of the asset will be replaced during its lifetime as well, right? When we have a different useful life now, so it means one once the life of the one part is not over, it's probable or it's possible that the life of the other part is getting over or something, so we have to replace it as well. Like for example, an air conditioning system might be replaced after 15 years, but the building has a useful life of 50 years, right? Similarly, an aircraft engine is required to be majorly overhauled or changed after every 5 years or every 4 years, but the life of the aircraft is normally 10 or 20 years itself, the body, right? Now, the problem over here is, or the issue that we have to address over here from the context of the financial reporting, is to decide the expected useful life of the asset in order to calculate a depreciation charge. That is, say in case if the cost of the asset is 100,000, the body has a useful life of 20 years, the engines, they have a life of 4 years. So the question comes in, now this 100,000, the value of the aircraft, should it be divided by what, 10 years, the life of the body or the exterior, or should it be depreciated over the 4 years, the life of the engines? Try to understand my point, that we have the exterior, we have the engines. If the exteriors have a useful life of say 10 years, so we divide the whole cost of the aircraft over the 10 years. Or if the life of the engines is 4 years, so we should divide it over the life of the 4 years. Right now, this is an issue, obviously speaking, because we have to decide about any of the two useful lives or something. Now that we have to take up over here, right? Now, obviously, as it's a complex asset, so it makes no sense to depreciate all the different component assets over the same expected useful life, because their expected life or their individual lives are different, right? So therefore, the complex assets, they are divided into different components, and then each component along with its own cost is depreciated over a different rate. Okay, so each component is depreciated over a different rate. So this is what basically we have to do over here, right? That this complex asset is going to be divided over its different useful life. Now, having been said that, let's go and take a look at its example. Let me just, yes, this is going to be over here. Let me share my Excel with you. I have already extracted the question because I knew. Yes, here we go. So, these are the questions from the exam kit basically we'll be doing today. But obviously, this is something related to whatever. This is again related to IE 16. We'll talk about these 31 and 30 and 31 over here in a while. It's a elite leisure company case question over here. And this is related to section B. This is section B of your syllabus. This is one of the MTQs over here that we have. Okay. This is one of the MTQs that we have over here about which I'm going to talk to you about. Okay. So if I now go ahead and talk about this one over here, we are going to have a scenario. I mean, this is the best question to talk about the section B as well. Look, we have this scenario over here, and then it also says that the following scenario relates to question number 57 to 61. Now we have 57, 58, 59, 60, and 61 over here as well, right? So till 61, we have these questions, and then again, we have other questions over here. Now, when we have this sort of an MTQ or something, then what should be the approach towards such type of a question in the paper? Now, one thing what we can do is we can start reading from here and we can go up to this last paragraph, right? And then we can jump onto the questions. Second thing is, remember, I have seen hundreds of MTQs. I have seen hundred of MTQs, not only of our F7 paper, even of the the tax paper as well, because I teach the tax as well, right? Apart from that, I have seen of the other papers as well while discussing with the students, or the random discussions that I normally have at the college as well over here, and with some other academy students as well, right? All of the MTQs are designed in a paragraphic form, like this is kind of sort of into the paragraphs, right? And then each MTQ is explicitly, or each the question that we have, right? It is related to a specific paragraph. I mean, if I start from here and I complete this paragraph, because this component is kind of the part of this paragraph now. So without looking anything, I mean, if I segregate up to this is going to be the one, this is going to be 2, this is going to be 3, right? 3 questions, and the next 2 questions, they are going to be related to either this one or either this one, right? So this is what the approach you should set in your mind, that don't go and read the whole one. Okay, I'm talking about from the paper point of view. Don't waste your time. Okay, time is of a sense, and time is really very precious during the paper. So move accordingly. Rather than reading the whole, just read one paragraph and then go to the requirement. Or what you can do is you can read the requirement in advance, and then you can read the scenario in order to get an idea that what is happening. Like for example, I go to question number 57, and this question number 57 states that at 30th September 20x4, the ship is 8 years old. The ship is 8 years old. What is the carrying amount of the ship at this date? Right? So this is the first question. Now, if I go at the start, it says Elite Leisure Company is a private limited company that operates a single cruise ship. The ship was acquired on 1st October 20W6, 10 years before 20X6. Details of the ship's cost and the components and the basis on which they are depreciated is as follows. So we have 3 components of the ship. One is ship's fabric, the cabin entertainment, and the propulsion system. And then we have the original cost over here as well. That is 300 million, 150 million, and the 100 million as well. Then we have this depreciation base as well. Then at 30th September, at 30th September 20x4, no further capital expenditure had been incurred on the ship. So till 30th September 20x4, no capital expenditure had been incurred on the ship. So what does it mean? It means that, Okay, it has zoomed a lot from the picture point of view that I've copied. Okay, till 30th September, the ship is 8 years old, so no, like, amount has been spent on it, right? So we have this information, and now the ship is 8 years old, so technically he has calculated, or the questioner has calculated the expired life or the time which has been passed till now. We already have this, so what we have to do is we have to calculate the carrying value. Now, the approach is we're gonna go over here. We have the component, we have the cost, accumulated depreciation, and then we have the carrying value as well. I have to zoom it a bit more because it will be more visible, as these are in thousands, millions, so I'm straight away taking them into the millions. So first thing is we have the ship's fabric. The cost is 300 million and the life is 25 years, right? So the cost is 300 million. Okay, let me just set it up. Okay. The cost is 300 million. The ship is now 8 years old and total life is 25 years. So this is going to be 300 divided by 25 into 8. Because divided by 25, 25 is going to be the total life. There's 25 multiplied by 8 because 8 years have passed, right? So I'm going to get my accumulated depreciation of 96 million. Done. So when I calculate my carrying value, I get what? 204 million. And this is for the ship's fabric over here, right? Then the second component. This is the cabin and entertainment area. Cabin area, the cost 150 million. 150 million of the cabin area is the total cost. The life is 12 years straight line. Now, we have the depreciation basis over here as well. The total life is 12 years. And we have to apply the straight line depreciation over here. Done. So in this case, this is 150 and 12 years. So I'll write 150. And then as far as the depreciation is concerned, this is going to be 150 divided by 12. Total life multiplied by 8. That is the time period which have passed. So when I do so, I get 100 million as the, accumulated depreciation. And here, the carrying value is going to be 50 million. Then I have my propulsion system. Propulsion system are basically the cruise ship's engines, right? I mean, in a boat, we have the propellers, propellers. So from that propeller for the cruise ship, from the propeller, we went into the propulsion and the system as well. So this is a propulsion system. The what should I call it as? The beauty of the English, putting up the unique words over here, right? So it's a propulsion system and it's an engine. So the original cost is going to be the 100 million. And look over here for the engines, the useful life is 40,000 hours, right? The total life is. And now if I look over here at the very start of the next paragraph, the propulsion system has been used for 30,000 hours at 30th September 24. So till 30th September, out of 40,000, 30,000 hours have been used by the engines, right? So we have an expired life of 30,000. So I'm going to go over here and the cost was 100 million. Okay. So 100 million cost. And now look, 100 by 40 into 30, right? 40,000 and 30,000, 40 by 30, it's going to be the same. So if I do so, I get 75 million over here. Now, if I drag it down, I get 25 million. Now, if I go and calculate the total carrying value, that is going to be 279. And this 279 is going to be option A over here, right? So out of the whole information that I had, I am simply going to go and I am going to choose this option over here, right? Now, question 58 is, what is the amount of the depreciation that should be charged in respect of the propulsion system for the year ended 30th September 25? Now, as I move ahead, The propulsion system had a useful life of 30,000 hours at 30th September 2024. Now, due to the unreliability of engines. Okay, now what is happening? The story has been cut short over here. Basically, what happened that at the very beginning of the next year, right, the engine had a very, the propulsion system had a very big engine trouble, right? Because of which, the cruise ship wasn't in a position to be operated or something, right? So, due to the unreliability of the engines, a decision was taken in early October 20X4 to replace the whole of the propulsion system at a cost of 140 million. Now, look over here. What happened? That the company decided to replace the whole of the propulsion system at a cost of 140 million. The useful life of the new propulsion system was 50,000 hours. And in the year ended 30th September 2025, the ship had used the engines for 5,000 hours. Now, we have already talked about the component accounting over here, that if we have a complex asset, and in that complex asset, if a component is replaced, if a component is replaced, then the old component's carrying value is de-recognized. Try to listen to me what I'm saying, okay? In complex assets where we have multiple components, if a component is replaced, the component's old carrying value is de-recognized and the new component's value is capitalized. And the new value, when capitalized, is depreciated over the new useful life of that particular component, right? I mean, whatever the component you're changing. Like, for example, you have replaced the propulsion system. So the old propulsion system's value or the carrying value is going to be de-recognized, and the new propulsion system's value is going to be capitalized, and it will be depreciated over its useful life, right? Now, if we take up the component accounting concept and we put it onto a side, and we look over here from a single asset point of view, this propulsion system had a useful life of 40,000 hours. Done? Agree upon? I mean, it's written right over here, right? I'm not saying anything from my own. The old propulsion system had a life of what? 40,000 hours. The new propulsion system has a life of 50,000 hours. This is 40,000, this is 50,000. So automatically, if we talk about from subsequent expenditure point of view, if we talk about from subsequent expenditure point of view as well, if you are incurring an expense on the non-current asset in such a way that its useful life increases or its performance is enhanced, that expense is capitalized, right? That is something which we have learned as well, read as well, apart from component accounting, that if an expense is incurred on the asset in such a way that its useful life increases or its performance is enhanced, then that expense is capitalized. Done? So technically, I mean, if we don't have that component accounting thingy in our mind, we can apply this concept as well. So over here, we are getting the new one at 140. The life is 50, used for 5,000 hours, and it's asking that what is going to be the depreciation charge. So we can say new propulsion systems cost 150 million, right? Life 50,000 hours, used in the year for 5,000 hours, right? So depreciation charge will be 150 by 50,000 multiplied by 5,000. So we get what? 15 million over here, right? So we get what? 15 million over here. So I'm not getting the 15 million. Why? New propulsion system cost. Okay, sorry. The new propulsion system is at a cost of 140 million, not 150. My bad. This is 140 million. Okay, okay. Okay, I mistakenly wrote the 150. It's 140 million, right? So 140, look, 140 divided by 50,000 into 5. So we get this, 14 million over here. And this 14 million is going to be option A over here, right? Done? I hope it's clear. Now, it's asking, apart from depreciation, what is the charge to profit or loss for the year ended 30th September 25? It's asking, apart from depreciation, what should be charged to profit or loss, right? Now, let's just go back. Now, we have replaced the item. Now, at the same time as the propulsion system replacement, Elite Leisure Company took the opportunity to do a limited upgrade to the facilities at a cost of 60 million and repaint the ship's fabric at a cost of 20 million, right? So as the engine was being replaced, company took the opportunity to repaint and then to upgrade its cabin area, right? Now, after the upgrade of the facilities, it was estimated that their remaining useful life was 5 years from the date of upgrade. Now, this information is crucial over here. This one, this information. Now, if I go over here, this is the facilities that I have, now, right? To upgrade the facilities. Now, if I go up, cabin and entertainment area fitting, these are the facilities we are talking about now. Now, if I look to this cabin area, it had a total life of 12 years. Agreed upon, this 12 years is given. Then at 30th September 2024, the ship is 8 years old, right? Total life is 12 and the ship over here is 8 years old. So what is the remaining life for the cabin and entertainment area? 4 years. Agreed upon? The remaining life of the cabin and entertainment area is 4 years at the moment. When you did an upgrade, the cabin's remaining life becomes 5 years. At the moment, it's 4. But when you do the upgrade, the cabin area life becomes 5 years, right? You have to be vigilant about it, what the comments are saying or what the story is saying, because you'll have the answers right over there in front of you. Okay? At the moment, the total life was 12, 8 were gone, 4 were remaining. You did the work, and after the upgrade, the life increased from 4 to 5 years, right? So the life increased, it has to be capitalized. So this upgradation of 60 million has to be capitalized. And repaint the ship's fabric at a cost of 20 million. Now, because of the 20 million, the repainting, nothing improvement came into place or something, right? So apart from the depreciation, if we go over here, apart from the depreciation, the repainting of ship, right? Repainting is for what? 20 million. This is going to be charged. And then old propulsion systems carrying value, we are going to have its disposal over here as well. We are going to have its disposal over here as well, because the old propulsion system, it has to be disposed of as well, right? Because if we scroll up, this is the old propulsion system standing at 25 million. So we will dispose it off as well. So we'll write this 25 over here, right? So if we do the total it becomes 45, right? So apart from the overall, the repainting and our propulsion system or the depreciation, we are going to have these two items that we have to charge. So the answer is going to be 45 million over here, right? So it's going to be 45 million over here. Okay, now question number 60. Elite leisure company's ship has to have a safety check carried out every 5 years at a cost of 50,000 in order to be licensed to operate. How should this be accounted for? Okay, now this is the concept, where apart from the IAS 16, we have to bring in the concept of the IAS 37, the provisions as well, right? Because over here, we have this sort of like, if you remember the future dismantling cost, the cost that we had to incur in the future, right? So what do we do with that cost? We capitalize it on day one, and then we have the present value of the future cost. We compress it down to the present value and we account it for, right? This is what we do. Agreed upon? I mean, there's no thought, there's no second opinion about that. Like, if we are using the asset, we are contaminating the site. So we have the obligation to clear the site. So we record the liability on the day one. Agreed upon? Now, look over here. Elite Ledger Company has to have a safety check carried out every 5 years at a cost of 50,000 in order to be licensed and operate, right? So every 5 years, we have to incur this cost, right? Like, for example, today is 2025. So we will have to incur this cost now so that we are able to operate till 2030 over here, right? Now, in order to get the license as well. Right? So we have to have a safety check carried out, and then we will be given the license to operate for the next 5 years. How this cost should be accounted for? Now, number one, set up a provision for the discounted present value and unwind over the 5 years. It looks very attractive over here, but tell me one thing. This cost, which we have to incur in order to record it as a provision, then there is one basic criteria with the provision that we have to meet, because provision is a liability of uncertain timing and amount. I mean, we are going to study the IAS 37 in detail in like a couple of lectures, but let's just talk about the basics, because this is something you must have read in the FA in the financial accounting as well. Very basic definition of the provision when we go into the liability, right? I mean, when we say the provision, it's a liability of uncertain timing and amount, right? Now, when we say that it's a liability, so what is the definition of the liability? A present obligation. It's a present obligation arising from some past event. For a liability to be recorded in your accounts, it has to be a past event. Otherwise, you cannot record it out, right? Now, this license cost, is it related to the past? Just read the statement again. Identify this 50,000 which you have to pay. Is it related to some past activity? It says that you have to have a safety check carried out every 5 years in order to be licensed and operate. That after every 5 years, you will incur this cost so that you can get the license for the next 5 years. Like, for example, if I have the cruise ship, I've been using it like, before, now it's 2025. So I have to get it inspected. Then I will get the license for the next 5 years. It has nothing to do what we have done in the past. The license which we are going to get is for future. It has nothing to do with the past. We have been profitable. Okay, fine. We'll go for it. If we have not been profitable, right, or if I don't have the money at the moment to spend on the license, I cannot use it, right? So how can we set up a provision at the very first place? Because it is not related to the past, it's related to the future. I will get my license to operate in the future, right? It's not something which is related to the past or it has something to do with the past. Because I just got my I will have my license for the next 5 years, right? So we cannot create a provision over here. The provision cannot be created for the future events. In order to create a provision, the event has to be from a past, okay? A past event can create a liability, otherwise it cannot. Getting the point, right? I mean, this is a concept checker over here. Whenever we have to incur a cost, and that cost is something which is going to have its benefit in the future, for that we cannot create the provision, okay? For that, we cannot create the provision, because long story cut short again, if you want to create a provision, if you want to create a provision, then the event has to be from the past, or it has to relate to the past. Otherwise, you cannot. End of story. Okay. So set up a provision and discount the present value and unwind over the 5 years. It cannot be the option. Done. Accrue the cost of the check over 5 years until it takes place. Why to accrue the cost over the 5 years? I mean, I cannot accrue it right now over the next 5 years, because the accrual says that the cost of revenue should be matched to the period to which it relates. Now, so how can I accrue it right now? Why to accrue it right now? I mean, I'm going to have its benefit over the 5 years now. So why to have the accrual cost right now? Because the benefit is something which is over there in the next 5 years. When I'll spend the money, then I'll have the benefit. It's not something I'm having the benefit right now and then at the end I'm going to pay. I have to pay in advance. Have I had I to pay in arrears, then yes, this is something you can have gone for the accrual and all that. Because if you are talking about making the accrual or something, it means you're saying that you have to create a liability, because accrued expense is a liability, right? So we cannot do so as well. Then charge 50,000 to profit or loss when incurred. We cannot charge it to the profit or loss when incurred, because its benefit is gonna be for more than 5 years, or till up to 5 years, or more than 1 year its benefit is gonna be. So we cannot have the whole expense into the income statement as well, because this expense is something whose benefit is over there for more than 1 year. So if for the benefit is for more than 1 year or something, then in that case, it cannot be, charged straight away to the income statement. So this is wrong as well. So what is the correct option? The correct option is going to be the D over here, this one, and that is it has to be capitalized. That is, we are going to capitalize the cost when incurred and then amortize over 5 years. Okay. We are going to capitalize the cost when incurred, and then we are going to amortize it over the 5 years. Okay. So this is what, I have to take up my approach over here related to this. Done? I hope it's clear to you. I mean, if you have any question or something, you can ask me. Otherwise, I hope it's clear, right? Okay, so let's go back. Let me share the screen. Okay, so we were talking about the complex assets over here. So this is how we have approached towards it, right? Then moving ahead from here, now we are going to talk about the borrowing cost over here. That is the IAS 23 over here. One thing only, it just clicked in my mind. I just have to confirm one thing, which I don't have in the mind at the moment. Okay, the cost is here. Site restoration and we have to talk about it. Okay. I just had to ensure that have we talked about the borrowing cost or not, and yes, we have not talked about it. So let's just have a discussion over here. Okay, sir. So the story, the borrowing cost. IAS 23, the borrowing cost allows the interest cost to be capitalized as a part of the non-current asset where the interest costs are directly attributable to the acquisition or construction of an asset, and the asset takes a substantial time to get ready for its intended use over here. Right? So, this is the story that we have overall speaking as far as the capitalization of the borrowing cost or the IS 23 is concerned. Right? This point now where we have to talk about explicitly as far as the IS 23 is concerned. Okay, now let me open up a Word file and take you there because it requires some notes to be written and talked about. What happened? Are you guys able to see the Word file or the Excel or both? I had this sharing issue. I don't know what file are you able to see. Please can you please tell me? Are you able to see the Word file, the Excel, or both?
It's a Word file.
Okay.
Yep.
Thank you. Okay, how am I supposed to fix from here? Just one second. I mean, I had some this sharing issue. Now we're gone. Okay. Okay. And now, okay, let's just talk about this IAS 23 borrowing cost. Okay. Now, IAS 23 gives or presents the criteria according to which we are allowed to capitalize the borrowing costs, right? Now, the borrowing cost is the cost of interest that we have to bear on borrowing the money or amount for borrowing the money which is used to finance the acquisition or construction of a qualifying asset. Right now, qualifying asset are the ones who take substantial time to complete or acquire. Right now, the okay, let's just write them as a point. Here we go. And then the capitalization starts when you actively start doing work for the acquisition or construction, right? And the capitalization stops when the asset is available for use. Now, if we talk about the borrowing cost, basically the borrowing cost standard allows you to capitalize the finance cost that you have to incur when you have taken up a loan and you are getting or acquiring or constructing the asset is concerned, and you have gotten the loan in order to do this thing. So the interest on that loan is something that you are allowed to capitalize. And the rule for the capitalization is that when you are going to actively start the work to acquire the asset or to get the asset, then the capitalization is going to start. And once the asset is available for use, you are going to stop as far as capitalizing the interest is concerned. Now, say in case you got the loan in January, but you were busy in your work or something because of which you couldn't get the time to start off as far as the construction or getting the asset was concerned, right? You started the activity in March. So for the January and February we will not capitalize the interest, right? I mean, when you are actively going to start the work for the acquisition or the construction, the interest will start to capitalize. Like for example, you had applied for the loan and you were waiting for the loan to get approved or something, then after that you will start hunting or getting as far as the asset was concerned now. So you had this thing in mind. So in January you got the loan approved and all, but the thing is that now you are busy in your some project which is into the final stages. So you just say that let's just get free from this project fund once, and then we'll start doing the construction of the asset now. So you end up getting around 2 months or so. I mean, getting from the old project or getting free from the old project is concerned now. So the capitalization will not happen or will not start, from the day you get the loan. Similarly, you complete the construction in September or October, right? For the warehouse which you wanted to have or the new building where you want to shift your operations or something, right? So it was completed in September or October. But again, because of the office work and because of the the moving and on and everything, you took around 2 months to officially shift your operations to the new place. So it all completed in September, but you ended up moving in December. So the interest for October or November or December, they are not going to be capitalized. The capitalization of the interest is going to cease on the very that day, on the same day when the asset is available for use. Once the asset is available for use, the capitalization is gonna full stop over here, over there, right? I mean, it's you. I mean, you don't use it for the next 5 years, it's your choice. It's your choice. You don't use it for the next 5 years, it's your choice. Okay. The standard is simple, the rule is simple. Once the asset is available, stop capitalizing. Bus. That's it. Done. And if we talk about one more point, the unique point that in case of specific borrowing, the interest is capitalized. Okay. The interest is capitalized by simply multiplying the interest rate with the total borrowed amount, right? So in case of the specific borrowing, what you have to do is just simply multiply it with the, the borrowing rate that you had, and then you are simply going to have the interest cost, right? And then in case of general borrowing, the weighted average of interest is taken to calculate the interest cost, right? Like, for example, you take a 5 million loan for construction at the rate of 9% per year, right? Now, the interest cost per year is going to be 5 million into 9%. 9 fives are 45. So you will have this at 450,000, right? Done. And let's assume you have a 6% loan note. That's for 500,000. You have a 12% loan note that has a value of 400,000. And then you have 8% convertibles for 300,000, right? And the total value is 1,200,000. Done? So their total value is what? 1,200,000 over here. Now, uh, you have now you have taken 450,000 of these general borrowings to acquire an asset, right? You have taken the loan of 450,000 from the general borrowings to acquire the asset. Now, what we have to do is, for this, we will calculate the weighted average. We will calculate the weighted average of general borrowing. How? I mean, if I go over here, this is 500,000 and the total base is 1,200 now. So that's gonna be 500,000 by 1,200,000 into 100. Then for this is gonna be 400,000 by 1,200,000 into 100. Then this is going to be 300,000 by 1,200,000 into 100 over here, right? So over here, we will get what? Tell me the percentages. Hurry up, come on. You guys have the calculator, or you must have the calculator. Come on, hurry up. Tell me the percentages that we have. Come on, I'm waiting.
First one, 41.67.
41.67. Well, let's just calculate at 42. Okay.
42.
Next.
30, 33%,
Okay.
25%.
Okay, 25 this one. Okay, thank you. Okay, so now we have calculated the weights over here, and these are the loan percentages now. So now in order to calculate the weighted average, we have this formula that the first one, the loan note, the interest rate is 6% into 0.42, or let's just write the 42% as it is. Plus, we have the next one at 12% into 33%. Plus, next one is 8% into 25%. Now, if we solve all of this, the whole equation, what do we get? Solve the whole equation over here. It could have been better if we would have been on the Excel. Let me just take out my calculator as well. Okay, we have 0.6 into 0.42, then we have 0.12 into 0.33, then we have 0.08 into 0.25. So I get this multiplied by 100 at 8.48. 8.48 or 8.5%, right? This is what I get now. Now, the loan is what? 450,000 multiplied by 8.5%. I'll have my interest cost of 38,250, right? So my interest cost is going to be 38,250 over here. Done? So that is how the approach I need to have over here. Done? I hope it's clear to you. Done? Where I am going to, have this weighted average. That is how I have to approach. Done? Now, I have to show you one more thing. Today, we are definitely going to ensure that we study the way a novel is read. We are going to go here and there again and again and again. Okay, so, okay, this is not now, but if we go down, yes, I have this question number 25. Bingo. Carriageway Company had the following bank loans outstanding during the whole of the 20x8, which forms the company's general borrowings for the year. 9% loan repayable 20x9 for 15 million. Then 11% loan repayable 20y2 for 24 million. Carriageway Company began the construction of a qualifying asset on 1st April, right? And withdrew the funds of 6 million on that date to fund the construction. Then on 1st August, an additional 2 million was withdrawn for the same purpose. Calculate the borrowing cost which can be capitalized in respect of this project for the year ended 31st December 20x8. Before we proceed to this question, because I've been doing it for so long now, I have to give you a disclaimer. When we are going to solve this question, we won't get the correct answer. I mean, we will have the correct answer via the solution, but that correct answer is not going to be over here. Okay, this is a disclaimer in advance. And why is it not going to be over here? I will show you with the help or via the solution, and then you guys are going to agree with me. Look, these exam kits, these are also like, man-made, one. Secondly, they tend to have an update and all, but still some points are somehow, some way left unamended or something, right? So there are some errors you will account for in the F7 exam kit as well, right? be it the BPP, be it the Kaplan, the errors are there, right? And how is it an error or something? I will show you, I will give you the proof as well. Then you are way better than me in the maths and, like, in judging as far as the question and everything is concerned. So you'll see over there as well. But again, it's a very healthy practice question that we have to do. And then we will do the other questions as well. And then you'll see we'll have the proper answers over there. Right now, let's see. Okay. Now we have this. Come on. We have this 9% loan. I hate it here. Okay. We have this 9% loan, and that is for 15 million. And then we have 11% loan, which is for 24 million, right? This is the million. And so my total over here is what, 39 million. If I take up the weighted average over here, this is 15 by 39. This is 24 by 39. So if I take it into the percentages, this goes into the 38% or 38.5 and 61.5% over here. Done? This can go like this. Agreed upon? So we have the weighted averages over here as well. Now, if I go to calculate the weighted average of loan, that's going to be 9% into 38.5% plus 11% into 61.5%. Done? That is the weighted average formula, na? So if I go over here and I solve it up, 0.09 into 0.385. Done? Plus, this is going to be 0.11 into 0.615. Done? Enter. I go into the percentage, and this is 10.230 or 10.23. Done? The weighted average has been calculated. Now, the loan. I took 6 million on 1st April. Year end is 31st December. So at first I had 6 million of loan with me, right? And this 6 million has been taken on 1st April now. So 1st April to, if I go to 31st December, how many months? April, May, June, July, August, September, October, November, and then December. 9 months, right? April to December, 9 months. So I'll go 6 million into 10.23% into 9 by 12. Done? Agreed upon na, for the first loan. That is the first amount. The first chunk is taken on 6 million. So if I try to calculate 6 million into 0.1023 into 9 by 12, I get 463.50, right? Then I took the loan of 2 million into 10.23% into, I took this 2 million on 1st August. August, September, October, November, December. This is taken on 1st August, na? So August, September, October, November, December. 5 months. So I have it over here for the 5 months separately, right? I just took the whole 6 month and I took it to the December. Or what I can do is I can take this 6 million from April to 31st July, then total 8 million from 1st August to 31st December. This is one and the same thing. Let me repeat. I have two options. Either I can take the 6 million, I can start from 1st April, I can go till 31st July. April, May, June, July, 4 months. And then I can have the total amount of 8 million from 1st August to 31st December. I can go by that. Or I can go like this as well. Getting my point, what I just said? Yes or no? Yes or
Yes.
no? Okay. So
Yes.
this is 2 million into 0.1023, 0.05. Sorry, not 0.05. Sorry. 10.23 is 0.1023 into 5 by 12. Done. And then the total. This is 545,600. And we don't have any option over here. The nearest one is 549, right? We don't have any option over here from this. Now, how are we going to get the answer? Surprisingly surprised. What is happening? I am going to copy this whole thing. Okay. I am just going to copy this whole thing just for the sake to show you how you are going to get the answer. What happens that if you try to explore the answer now, this is 10.23 now. I'm going to write it as 10.3, then 10.3. Then this is 10.3, not 23 now. So I am going to have it as 103, then 103. Bingo, you got the answer 549. Now, I asked from you, you guys tell me, how on earth can I round off this 10.23 to 10.3? How can I round it off? The 10.3, what a rule of maths is where I can round it off 10.23 to 10.3? See, now this is the issue. I mean, I try to work around it the way, it has to be done or something, but I don't get this answer by any way, right? So I've just shown you the issue over here, right? So that is why I gave this disclaimer in the start, right? That, this answer is something we are not going to get. And I straight away showed you how we are going to get the answer. But if you think about what if you get such a question in the paper, then what? Then hello, I mean, the exams, the standard and everything, you're not going to have such a situation over there, right? I mean, you're not going to have such a situation over there where, like, there is some rounding off error or something. This is just a rounding off thing, right? This is a random rounding off issue over here. 10.23 can never ever be rounded off because I showed you over here, like, if I go over here, I even if I try to go way beyond to see, like, what are the figures behind, like, maybe because of something it's been rounded off to 10.3 or something, I don't find any. But long story cut short, this is how you have to solve the question when it comes towards the general borrowings, right? Done. This is one of the exam kits question. Okay, I hope it's clear. Now let's see the other one. We have this question over here as well. This is question number 26 from the exam kit as well. Now, Electric Company has borrowed 2.4 million to finance the building of a factory. Construction is expected to take 2 years. The loan was drawn on 1st January 20x9 and the work began on 1st March 20x9. So you got the loan on 1st January, but you started the work on 1st March. What is the rule? You are going to capitalize when the work is going to start. Okay. The rule is you are going to capitalize when the work is going to start. Done? Not when you got the loan. This is what we have read, and this is what we are going to apply now. Okay. So you borrow 2.4 million. The loan is taken on 1st January. The work is starting on 1st March. Now, interesting point, very interesting point. 1 million of the loan was not utilized until 1st July. So, LACREC was able to invest it until needed. So, what happened? You got the loan, you had it with you, but 1 million was not used, so you reinvested it. Now, this reinvestment which you have done, what's happening? you are getting the interest over here as an income as well from the amount which you have borrowed. Lacquer company is paying 8% on the loan and can invest surplus funds at 6%. You have taken the loan, you are paying the 8% interest cost, and you are investing at 6%. Now, logically speaking, logically speaking, the amount of interest that we are allowed to capitalize, the amount of interest that we are allowed to capitalize over here is going to be the net interest cost. Okay, we have to take up the net interest cost over here, because if we have the opportunity to get like um some interest income or something, we are going to net it off, right? We'll not have the total interest cost over here, right? If we are getting something as an income or something, we are going to net it off and all. Right, now let me just show you how we are going to do the amount. The loan is for 2.4 million. We are going to have it. We got the loan on 1st January, but we started off the work on 1st March. Year end is 31st December. So for the whole year, the interest cost is going to be there. January, February, 2 months are not there. From 1st March, we have to capitalize. So out of 12 months, for the 2 months, we are not supposed to capitalize, right? But for the 10 months, we will be capitalizing from March to December. If you count, these are 10 months, okay? And the cost of loan is 8%. So the interest cost is going to be 2.4 million into 8% into 10 by 12. So that is 2400 into 0.08 into 10 by 12. That's 160,000 the interest cost. Then TEREST interest income 1 million. You can invest it at surplus funds at 6% into how much time? The loan was not utilized until 1st July, until 1st July. So it was reinvested till that time. Done. And the work began on 1st March. So from 1st March to 30th June, the amount was invested. So we'll have this relevant interest with us. March, April, May, June. March, April, May, June. 4 months, right? So I'll have it over here from 4 by 12. Now, before I go towards solving and all, I took the loan from March to 1st July, that is the 30th June, March, April, May, June, for the 4 months, right? If you look over here closely, I got the loan on 1st January, right? I got the loan on 1st January. Done. So I had the whole money with me. I invested it straight away, right? And it was not utilized till 1st July. So technically, from January to June, I have 6 months over here. I have 6 months over here. Why am I not capitalizing it for 6 months? Why 4 months? Why don't I have it for the 6 months? Why am I capitalizing it for the 4 months? Shouldn't I go for the 6 months? Because I got the loan, I straight away invested it up, right? I mean, if I, talk about as far as capitalizing the interest cost is concerned, so yes, it's logical when I start to do the work to acquire the asset, I should capitalize it from that time. But as far as the return is concerned, I got it from the day one. So what's the big deal? Why should I be taking up the 4 months? Why not the 6 months? Shouldn't I go for the 6 months over here? Right? I mean, if I see over here, I got the loan on 1st January now. Out of this 2.4 million, 1 million was not required until 1st July, that is the 30th June. So from January 1st to 30th June, it's 6 months. Shouldn't I have capitalized it for the 6 months? I need your answer. We have Devishi over here. Devishi, what's your opinion? Come on, hurry up. Miss Devishi, if you can unmute yourself. Etwaru,
No, because the work actually began on 1 March.
so what? I mean, if your work is beginning from the 1st March, so what's the issue over here?
The cost should start to be capitalized as from 1 March itself.
No, I'm not talking about the cost. Look, the interest, I am capitalizing it from the 1st March point of view. As far as the interest cost is concerned, I'm capitalizing it from the 1st March point of view. The interest income I'm asking, why am I starting to capitalizing it from the March? Why not the January? The cost is capitalizing from the March when the work is beginning. But I had the amount from the day one. Now, so what's the issue? I mean, I can straight away go to capitalize it for the 6 months. Gautam. Gautam, you there? Come on. Kevin. Guys, come on. At least I need some input from you. I mean, I cannot have this silent treatment. Numan. Shama. Okay. Yusuf.
I guess you didn't know that you'll be using the funds. You'll not be using the 1 million until 1st March of 20th time.
No. Look over here. Read the question again. Read the question again. The loan was drawn on 1st January, right? And 1 million of the loan was not utilized until 1st July, right? We got the loan on 1st January, and 1 million of this was not utilized until 1st July. That is for the 6 months, right? So my question is that we have invested the 1 million, we have invested the 1 million for 6 months, right? So why am I not taking the 6 months over here in this 4? Why am I not taking the 6 over here? Why 4 over here? This is what my question is.
I have no idea.
You say what?
You have no idea.
You have no idea. Okay. Okay then. Okay, you can mute yourself again. Okay, anyone else? Gautam, you are over here?
Yes, I'm here.
Okay, Gautam, tell me, what's your opinion?
Mm,
Okay,
can I look
question
at the
again?
question again? Yes.
Here you go. Okay, Miss Shama has given an interesting point, another side or another angle, that this 1 million of the loan, it was available, or we got to know about this 1 million is not going to be used, what, from 1st March? This is what Miss you are trying to say? 1 million remained after 1st March. No, we started the work on the 1st March. Ms. Sharma, it's not gonna be, or yes, you can if you want to, but still, it's not a valid angle. We started the work on the 1st March for that. Like you can have this example, na? Yeah.
If we take the interest, so we have to take 2.4 for the first 2 months. We receive interest for that because we didn't utilize the money for investment.
Can you repeat
For
yourself again?
construction.
Can you please repeat your point again?
From 1st January to March, we didn't utilize the 2.4 million. So if we have to calculate interest, we have to calculate for the 2 months on 2.4 and the remaining 4 months on 1 million.
Okay, very interesting point you have raised. Like, look there. Thank you, Ms. Sharma. I got your point. I got your point. Look over here. This is a very interesting point over here she raised. I mean, honestly speaking, I did not happen to see it from this angle that we got the 2.4 million of the loan on the 1st January, right? We did not start the work on the March now. So the 2.4 million, the whole of the amount should have been invested, right? For the 2 months, for the January and the February. And then the remaining 1 million would have been left into the investment. But if I try to look from this point of view, now, it is nowhere mentioned in the question that 2.4 million of the loan that we got, it was straight away invested. Point number one. So we cannot take the whole of the interest on that 2.4 million for the January and the February as well. Done. And this question explicitly mentions over here that the 1 million of the loan was not utilized. So that is why 𝐁𝐿𝐴𝐶 was able to invest it. This 1 million of the loan was not utilized. It's nowhere to be mentioned that it has said that 2.4 million was, invested. Okay. Since we should take the net interest cost, the investment income also should be as from March. Okay. Atwaru, Miss Prerna, I would rather say, right? I hope I can call you Miss Prerna. She has, yeah, she has gotten a very, valid point with a pinpoint accuracy, which I was trying to look as well. Finally, see, this is something I was looking for, that, you start using your minds. I mean, one way is I just come over here, I give you the lecture, you just listen to me, and then you guys go back. One is you start critically thinking about the scenarios as well. Very good, Ms. Prerna. This is what I was looking for. Now, let me just refine it more. At least I got what you want to say. Look, the rule for capitalizing the borrowing cost is that we start to capitalize when the active work starts, right? And if there's some interest income, we should net it off. The rule for capitalizing the interest cost starts from the point when the active work starts, na? So logically, if we are capitalizing the interest cost from the time when the active work starts, so logically the income should start for netting off from the time when the active work starts. I mean, we have gotten the loan from the 1st January. Why not to capitalize the interest cost for the January and February? If we are not capitalizing it, then why to bother the income of the January and the February as well? Logical point. I mean, if we are allowed to capitalize when we start off the work, na, and then we have to net off the interest income. So the dates have to be same. That if you start to capitalize from this point, the income will net off from this point as well. If you are starting to capitalize the interest from the beginning, then the income will start netting off from the beginning as well. Because the matching is not going to be achieved if we take the income from the earlier time period as well and the expense from the later. No, it has to be equally treated, right? So the rule is that we have to capitalize the interest cost when the work starts to begin, then the income has to be taken up from the same time as well, right? This is the point. This is the valid thing which I was trying to look for. Because we started off the work in the March now, so the income account is going to be started for us from the March, not from the January. I'm not saying we have not earned the interest in the January and February. We must have earned the interest in the January and February as well. But that's going to go into the other income, not over here to net off the interest cost over here. Okay. Now let's just solve it out. So we have this 1 million 0.06 into 4 by 12 and then minus. So 20,000 is going to be netted off over here. 140,000. Option A. So this is going to be the answer. Okay. So that is going to be the answer over here. Done? Okay. If anyone has any question, you can ask me.
Yes, I had one question. So you said that we cannot start capitalization until the work started, right? So the work started on, I think, on
First
March,
March.
right? First
Yeah.
March. So March, April, May.
Yeah, this is first March over here.
Okay, okay, I got it. I got it. Yeah, it's okay.
So
Yeah, good.
what's your
I'm good.
question?
No, I'm good. I'm good. I was just thinking how we got 10. Now I got it. It's okay.
Okay,
Yeah.
okay. Yeah, the work started on the March. Okay, done.
Yeah.
Okay. We had a very healthy, discussion about this. Now I have this question feed over here. This is again related to the borrowing cost. Now I'm waiting for your answers. I'm gonna give this question to you, and I want to know that what amount should be capitalized as borrowing cost at 31st December in respect to this asset. Come on, hurry up, solve this for me. You have 3 minutes. I'm right here if you need me, okay? Hurry up, solve this question. Let's see what do you have to offer. Okay, we are getting the answers now. Okay, Naman, I got your answer. And Sham, I got your answer as well. What about, okay, Miss Prerna got the answer as well. So it's more or less same like the others. Okay, very good. And what about the others? Okay, Miss David, she got the answer as well. Okay, your answer is correct as well. Miss Shama, I guess you had a typo error. You wrote it as 22.06. Is it 2.2 or 22.06 what you got? 2.2, okay. Okay. Okay, it's 2.2. Okay. Done. Everyone is correct. 2.2. 2.2 is gonna be the answer over here. Done. 2.2 is the answer. Very good. All of you got the answers. Okay. Very well done. Very well done. Okay. Now it's time to have a break to get up from our seats. Let's have a break of 5 minutes or so. We are going to come back and then we are going to zoom. Okay, let's maximum 5 minutes. Okay, let's have a break. Okay, so we are over here with the capitalization of the borrowing cost over here. Now, if you move forward over here, we have the subsequent valuation, and the subsequent valuation we talked about as far as the the cost model and the fair value model is concerned, where we last time talked about in the cost model, we have the straight line depreciation, we have the reducing balance depreciation as well. Method, these are the only two valid methods into the IAS 16 or the International Accounting Standards. So we did happen to solve the questions related to these, and then we had the fair value model in which we had to talk about as far as the fair value was concerned, right? So we talked about the fair value, and then we did happen to talk about one of the examples as well, where we did solve the question where we looked at the the fair value amount and the the carrying value that we had with us, and then we ended up doing that as well, right? So what I am going to do is, as far as for the fair value is concerned, I remember last time few of you had this opinion that we went a bit fast and as far as doing the example was concerned. Now, so we'll have one more example over here for the fair value model application, and then we'll move forward. So fair value model, the asset is reported at its fair value. Example, let's say we have an asset's cost for 100,000. Let's just change it from 100 to 550. Life is 8 years. And then after 5 years, the asset is appraised as having a fair value of okay, 300,000. After 5 years, the asset is appraised as having a fair value of 300,000. How this should be accounted for, and calculate the next year depreciation charge, and also what options are available for revaluation reserve, right? So we'll talk about this thing over here as well. Now, the rule is simple, that we have the value of the asset at the after 5 years. So the first thing first, calculate the carrying value of the asset at the end of year 5 divided by 8 into 5. This is 312,500, right? So carrying value is 312,500. We get a fair value 187,500. Done? So this is the carrying value at the end of year 5. Now, this carrying value has to be compared with the fair value, right? So the fair value is 300,000. The carrying value is 187,500, and the difference, as it's more, so it's going to be the revaluation gain over here, and the gain is going to be 112,500, right? So we have a revaluation gain over here of 112,500. Done? Now, next approach, how to record. The recording is going to be simple. We just go for the net entry method, where only the carrying value accounts are maintained, right? Over here, you are going to debit the asset with the revaluation gain of 112 500, and you will credit the revaluation reserve with 112 500, right? Where the separate cost and accumulated depreciation accounts are maintained, where you have a separate account for the cost and the accumulated depreciation. Over there, the revaluation gain is treated as a reversal of accumulated depreciation, because you thought that the asset is going to decrease its value. That is why you charged depreciation, nah? But in actual, it did not, right? So over there, you will have the reversal of, the accumulated depreciation. Okay. Is the cost 500 or 550? What have I written? Okay, the cost was 550, but I've written 500 and I've solved the question according to 500. So let it be 500 now. Let it be 500 because I've solved the whole question on the basis of 500. I assumed the figure, but at the end, I ended up 500, 1, 2, 3 by 8 into 5, 3125. Yeah, I solved the whole question on the 500 base. I'm sorry, I wrote it 550, but I solved the question on 500. Let it be on the 500 now. Okay, now, where the separated cost and the accumulated depreciation accounts are maintained, the revaluation gain is treated. Yeah, Ms. Devishi, no shoes. Okay, the revaluation gain is treated as a reversal of accumulated depreciation. What does it mean? It means that the depreciation is basically is an estimation. You estimated that in 5 years' time, the asset will lose its value by 312 500, and it will have a carrying value of somewhere around 187, right? But in actual, the asset had a little loss in its value as compared to what you thought, right? So whatever the little is, we are going to reverse it from the depreciation, because we thought the asset is going to lose its value by 312, but in actual, it lost its value by a lesser amount, nah? So whatever the higher charge we have made in the name of depreciation, we are reversing it. So over here, the double entry is going to be, we are going to debit the accumulated depreciation by 112 500 and credit the revaluation reserve with 112 500. For this, cost minus accumulated depreciation is equal cost minus accumulated depreciation is equal to carrying value. So the cost was 500,000, accumulated depreciation at first was 312 500. So we are reversing 112 500 from it, right? Okay. So we'll have this carrying value now. And if we try to solve it at 312 500 minus 112 500, so the remaining amount is going to be 200,000 over here. So 500 minus 200, this is going to be 300,000, which is now our, fair value is, right? So everything is going to be in order now, okay? So where we have separate arrangement for the cost and accumulated depreciation, where we have a separate arrangement for the cost and accumulated depreciation, over there we reverse the depreciation first, right? And where it's the net account or something, and where there's some net accounts, so the carrying value accounts are maintained. Over there we will have this only net of difference where the asset is debited straight away. Okay, so this is what we are going to have over here. Done. Now depreciation charge for the next year will be the revalued amount divided by remaining useful life. Revalued amount 300,000, remaining useful life, total 8 years, 5 years ago, so 3 years are left now. So divided by 3 years, so you will have this 100,000 as the depreciation charged for the, remaining years or for the revised year, right? So that's how you are going to have it. Now, this formula is simple. You just have to remember that the revised depreciation charge, this is going to be from the time when the revaluation has taken place, and then you accounted for, right? Now, moving ahead from here, the next point that we have over here is the revaluation reserve that we have. I mean, if I try to, create an extract, okay, extract of statement of comprehensive income, extract of statement of financial position. We had this depreciation charge when we had the revaluation, and the older depreciation charge was 62,500. This was 62,500. Then the asset got revalued to 300,000, and then in equity you had this revaluation reserve, and this was standing at what? Where's the revaluation reserve? 112,500, right? So this is what we have right after where we have the revaluation at the end of the year, right? So this is what the arrangement is going to be. Now, the next year, the depreciation charge, this one, if I look over here, let's just cut it down from here and paste it here, because this will be more logical and in sequence. That at first we had the charge for the year in which we had the revaluation, and then this is the revalued amount over here, and this is the revaluation reserve now, right? And this asset next year it's going to be depreciated like this, right? Now let's just talk about this revaluation reserve. This revaluation reserve, what to do with this? Now, there are two ways to realize this revaluation reserve. In order to realize this revaluation reserve, we have two options. I mean, if you want to realize this revaluation reserve, you have two options. One, sell off the asset, realize the gain, and the revaluation reserve instantly. I mean, one option is straight away go sell off, dispose of your asset, straight away realize the revaluation reserve, right? Like, for example, after 4 days, you dispose of the asset for 305,000, right? After 4 days, right? Straight away. After 4 days, you straight away dispose of the asset for 305,000. Now, what's going to be the entry over here? The first entry is we are going to debit the cash with 305. We are going to credit the asset. Asset's value is what? 300,000 over here, right? Now, the 300,000 asset has been sold for 305,000. So you'll have a credit in income statement as a gain on disposal of 5,000, right? Basic entry, na, where you just dispose of an asset. So you debit the cash, you credit the asset. Simple. Now, when it comes towards a profit or loss, you had the asset for 300,000, you sold it for 305, you are going to have a gain. Now, suppose you sold it for 298 over here. You sold the asset for 298, you'll have a loss on disposal and all, right? So over here, you just had a gain. Then with this, the corresponding second entry, will be related to this revaluation reserve, because if you have sold the asset, you cannot maintain this revaluation reserve over here as well, right? So for this, what will happen? You will debit the revaluation reserve, right, with 112,500, and you will credit retained earnings with 112,500. This revaluation reserve cannot be taken to the income statement because this gain is not realized when we had the revaluation. I mean, if I ignore this whole point, the revaluation thingy over here, the disposal, when I have this, the gain over here, this gain cannot be taken to the income statement as a gain on asset because this gain is not from the operations and this gain is not realized, right? So that is why we created the revaluation reserve over here and we took it into that, right? Now, if we want to realize this gain, we have two options. One, sell of the asset, realize the gain, and the revaluation reserve instantly. We straight away sold the asset, we realized the gain, and this gain straight away went to the retained earnings, right? The second point, keep on using the asset and realize the gain over the remaining life of the asset. Keep on using the asset that you have, right? And then realize the gain over the remaining life of the asset. Okay. Now, what does it mean? It means you are going to keep on using the asset. Done. And then, as far as for the realization of the revaluation reserve is concerned, realization of revaluation reserve will be realization of the revaluation reserve will be what you have to do is revaluation reserve divided by remaining useful life of asset. So the revaluation reserve is 112,500. Remaining life was what? 3 years, right? This is 3 years. Done. So that's gonna be 112,500 divided by 3. That is 37,500. All right. So that's gonna be 37,500. And for this, the entry is going to be debit revaluation reserve 37,500, and we are going to give a credit to retained earnings. Again, the credit is going to be for the retained earnings, not for the income statement. Okay. This revaluation gain can never ever go to the income statement. Okay. Of the non-current assets, static non-current assets. There are some other situations we'll talk about later, but for the non-current assets, the tangible non-current assets, the assets under the IAS 16, we cannot take it to the income statement. Period. Okay. So we have this way of realizing this revaluation reserve. Now, from another point of view, this information which I'm going to write, this is an additional add-on information for yourself, right? Or for an understanding. This revaluation reserve can be calculated as the difference between the new and old depreciation as well. This revaluation reserve realization amount. This revaluation reserve realization amount can be calculated as the difference between the old and the new depreciation as well, right? Now, new depreciation charge. What's the new depreciation charge? 100,000. Less old depreciation charge. What is the old depreciation charge we had? Where's the old depreciation charge? 62,500. 62,500, right? Difference. I don't have to calculate. I know. 37,500. See? So this can be calculated as the difference between the old and the new depreciation charge as well, right? So this is calculated at the same, because technically we had this old depreciation, this is the new one, and it has to be spreaded over the life of the asset. Similar is the case that this realization has to be done as well. So the other way around is the extra amount that we are charging in the name of the depreciation after the revaluation, that extra amount has its counter effect in the retained earnings with the revaluation reserve, right? Its counter effect is available over there to net off the counter effect we have for the excess charge of the depreciation. Okay, so we can have it like this as well. Done. So I hope now this revaluation part, the double entries which we learned today, they are now clear to you, which we had to happen to, like, discuss the last time, when we were ending the class at that time. I hope it's clear now. The picture is over there. It's just that the newer concept is where we talked about as far as the realization of, the revaluation reserve is concerned, right? Okay. Now let me just check one thing. Okay. Okay, done. Now, moving ahead, I have a few questions again. Let's go there. At the start, I had these two questions. Yes. Now we'll talk about from the component accounting and from the revaluation point of view as well. Okay, so this is the question 30 that I have first. And whether my company purchased a machine on 1st July 2027 for 500,000, it's being depreciated on a straight line basis over its useful life of 10 years. Okay, so useful life is 10 years. Now, the residual value is estimated at 20,000. Okay, so you got the machine on 27 for 500,000 and its scrap value, the residual value is 20,000. On 1st January 2028, following a change in legislation, Weather Company fitted a safety guard to the machine. The safety guard costs 25,000 and has a useful life of 5 years with no residual value. What amount will be charged to the profit and loss for the year ended 31st March 2028 in respect of the depreciation on this machine? Okay. Now, this is a sort of a question where the component accounting kicks in, right? So, but let's just talk about it as well. So, what we are going to do is we have the machine and then we have the safety guard now. So, machine's cost is going to be depreciated separately. Then the safety guard will be taken into point, like, separately as well. So, the machine, we got it for what? 500,000 minus the scrap value is 20,000 and the life is 10 years. Minus 20,000, life is 10 year, multiplied by, we got the machine on July, the year end is 31st March. So 1st July to 31st March, 9 months, because July to December is 6, then January to March is 3. So 6 plus 3, it's 9 months now. So we'll have the depreciation of 9 by 12. So that's going to be 36,000 over here, right? Then we have the safety guard over here. And if we talk about the safety guard was cost, safety guard had a cost of 25,000, life of 5 years on the 1st January. So January, February, March, 3 months. So that's going to be 25,000 by 5 years into 3 by 12. So 25 by 5 into 3 by 12, I get 1250 over here. Total 37,250. This is going to be the answer over here, right? So 37,250 is going to be the answer over here. Done? Okay, then we have question 31 with us. Auckland Company purchased a machine for 60,000 on 1st January 20x7. Okay, sorry. Auckland Company purchased a machine for 60,000 on 1st January 20x7 and assigned it a useful life of 15 years. Now, on 31st March 20x9, it was revalued to 64,000 with no change in useful life. Now, what will be the depreciation charge in relation to this machine in the financial statements of Auckland Company for the year ending 31st December 20x9? So we got the machine on 1st January, right? And then we had the revaluation on 31st March 20x9, right? Okay, so now we have to approach with this. Now, overall speaking, what we have to do is we have to calculate the relevant amounts and figures over here. So basically, first we have to start from 1st January. Then we have to go to 1st January 20x9 first, right? We'll calculate the value at the start of the year. Then we'll have the depreciation for the 3 months. Then we reevaluate and then we'll calculate the more depreciation, right? Okay, now, first thing first, carrying value of, this is machine. Yeah. Machine at 1st January 20x9, right? Because then the amount and the calculations are going to be easier for us. That's going to be 60,000 by 15 years into 2. So the cost is 60,000. 60,000 by 15 into 2 is 8,000. So the value at the start of the year is going to be 52,000. This is the value at the start of the year, okay? Then moving ahead from here, if I see up to 3 months, there was no issue, right? So depreciation charge till 31st March. This is going to be 60,000 divided by 15 years into 3 by 12. I have a depreciation of 1,000 over here, right? So over here, I have the depreciation of 1,000. Now, depreciation for remaining 9 months is what I have to have, right? And the formula for the revised depreciation charge formula is revalued amount divided by remaining useful life, right? This is what we have read now. So the revalued amount, it was revalued to 64,000, right? So that's going to be 64,000 divided by remaining life. Now, this is the issue. We don't have the straight remaining life over here. Now, if I go in 20x7, the machine had a total life of 15 years. At the start of the year, life is 13 years at the start. Then 3 months gone, revaluation took place, right? So remaining life is 12 years and 9 months. Now I have the remaining life of 12 years and 9 months over here. Now, obviously, I cannot write it as a 12.9 over here, right? Because if I add 1.1 more over here, it will become 13. But there are 12 months, right? Try to understand. I cannot write it as 12.9 over here as the life, because after 9 it's 10 now, so 12 will go into the 13. But the number of months are 12. So this is the rocket science over here, right? Now, what I can do is I can convert it to the number of months, because I have to calculate for the 9 months over here. Either I should convert the 12 years into months, or I should convert the 9 months into the number of years, right? That's going to be 9 by 12, right? So I can do that as well. So I have the both options how I want to proceed with it, right? I can either convert it to the number of months, the years, or the number of months into the year, because I have to go with the one scale over here, right? I have to have a one scale over here, not multiple. I just set the scale to the years, I just set the scales to the months. Okay, so I'll be converting it both ways. First, I'll go for number of months. That's gonna be 12 into 12 plus 9. I have 153 months. And if I go into number of years, that's gonna be 12 plus 9 by 12. It's not 13. I have this formatting over here. So this is gonna be 12.75, right? So I can either go for 12.75 years, or I can go for 153 months. Done. So over here, if I solve it, 64,000 divided by 153 into 9 months, I get 3765 over here. Okay, I get 3765 over here. And if I go by the years, I'm solving the years over here. Okay, so this is gonna be 64,000 by 12.75 into 9 by 12, because 9 by 12 are the number of years now. So this is going to be 3765, or rather 9 by 12, I multiply it with 0.75, I get 3765, the same, right? So no matter you go for the months or the years, but you have to go in one scale in order to calculate it up, right? So if I do the total, that's going to be 4765, right? Okay, so 4765 is going to go over here. Done? I hope it's clear. I hope it's clear to you. Done? Okay. Okay, given the time at the moment, let's just stop over here. We are still, let's just go back for 1 second only. Just for 1 second. Okay, where was, okay, here we go. Okay, we have to start with as far as the government grants are concerned. We have to start with as far as the government grants are concerned, but given the time, we don't have much time to talk about and do the examples and all now. And then after the government grants, we have the investment property as well. So let's have it for the next class. In the next class, we are going to discuss about the government grants, investment property, and then we'll incorporate the small other standards with this as well, right? So let's just stop over here. Again, I don't want to rush, because at the end, I want to ensure that you guys are, well equipped with as far as the basics are concerned, right? So we'll stop over here. What you have to do is whatever we did today, the exam kit, the notes, and the slides. I'll share the slides as well over there in the class, right? So just go through these, and obviously, you know the trick. If you come across any problem or something, do let me know, and I will be more than happy to assist you and guide you in all that, right? So this is all I have for now. Now, meanwhile, you guys have any question or something, you can ask me. Any question? Okay, none. Okay, fine. So I guess it's time to say bye now. The weekend is coming, so do plan about the weekend as well, that how you're gonna enjoy and all, right? And I am going to see you again, same time, same place, same channel, with the new topics and with the new discussions, right? So till then, you have to wait for the whole week. And till we meet again, now it's time to say a final bye bye. So take care of yourself, your family, your friends, and the people around you. Take care. Bye.